Most retirees think Roth conversions are simple. Move money from a traditional IRA into a Roth IRA, pay taxes now, and enjoy tax-free income later. That's the basic idea. But what most people never realize is that Roth conversions have levels, and the higher the level, the more powerful the strategy becomes. The average retiree only reaches level 1 or level 2. Financially aware retirees may reach level 3. Very few ever reach level 4. And level 5? That's the level many professional advisors use quietly behind the scenes to legally reduce lifetime taxes, protect retirement income, and create more flexibility for the future. If you understand these 5 levels, you'll start looking at retirement taxes completely differently. Because retirement is not only about how much money you saved, it's about how much you actually keep after taxes. And here's the problem. Many retirees unknowingly create a tax time bomb. They spend decades building large traditional IRAs and 401ks, believing they're doing everything right. But later in retirement, required minimum distributions, Social Security taxation, Medicare surcharges, and rising tax brackets begin hitting all at once. Suddenly, retirees who thought they would be in a lower tax bracket end up paying far more taxes than expected. That's why Roth conversions matter so much. A Roth conversion gives you control. It allows you to decide when to pay taxes instead of letting the IRS decide for you later. But the strategy only becomes truly powerful when you understand how the different levels work together. So in this video, we're walking through the 5 levels of Roth conversions most retirees never reach. Each level gets more advanced, more strategic, and more valuable. By the end, you'll understand why sophisticated retirees and advisors approach Roth conversions very differently from the average investor. Let's start with Level 1. Level 1 is the basic Roth conversion. This is where most people stop. They understand the general concept, but they never go deeper. Here's how it works. You move money from a traditional IRA or traditional 401k into a Roth IRA. The amount converted gets added to your taxable income for the year. You pay taxes now, but future qualified withdrawals become tax-free. Simple. For example, let's say a retiree converts $20,000 from a traditional IRA into a Roth IRA. If they're in the 12% federal tax bracket, they may owe around $12,400 in federal taxes on that conversion, not including state taxes. Why would someone voluntarily pay taxes now? Because they believe taxes may be higher later. And for many retirees, that's exactly what happens. Large retirement accounts eventually trigger required minimum distributions. Those withdrawals increase taxable income every single year. Higher income can also cause more Social Security benefits to become taxable. It can increase Medicare premiums through IRMAA surcharges, and it can push retirees into higher tax brackets later in life. So Level 1 is simply understanding that paying some taxes now may save much larger taxes later. That alone already puts someone ahead of many retirees. But Level 1 has a major weakness. Most people doing basic Roth conversions focus only on this year's taxes. They don't think strategically across decades. They convert random amounts without considering future tax brackets, Social Security timing, Medicare thresholds, widow's penalties, or long-term tax planning. That's why Level 2 matters. Level 2 is bracket management. This is where Roth conversions start becoming strategic. Instead of converting random amounts, retirees intentionally convert only enough money to fill up lower tax brackets without spilling into higher ones. This is one of the most powerful concepts in retirement tax planning. Here's why. The U.S. tax system is progressive. Different portions of income are taxed at different rates. So smart retirees often ask one critical question every year. How much more income can I take before entering the next tax bracket? That unused space becomes an opportunity. For example, imagine a married retired couple has taxable income that places them comfortably inside the 12% federal bracket. They realize they still have room before crossing into the 22% bracket. Instead of wasting that low tax space, they convert additional IRA money into a Roth IRA while taxes remain relatively low. They are proactively using lower tax brackets before future required minimum distributions force larger taxable income later. This strategy becomes especially powerful during early retirement years. Why? Because many retirees experience temporary low-income years after they stop working but before Social Security and RMDs fully begin. That window may last several years. And for strategic retirees, those years are golden opportunities for Roth conversions. Think about the timeline. A retiree stops working at age 62. Social Security may not start until 67 or even 70. RMDs currently begin later in retirement. That creates a gap where taxable income may temporarily fall much lower than usual. Advisors often call this the tax valley. Sophisticated retirees use that valley aggressively. Instead of wasting those low-income years, they deliberately convert portions of traditional retirement accounts into Roth accounts at favorable tax rates. This is where many retirees first begin seeing the real power of Roth conversions. Because the goal is no longer simply tax-free growth, the goal becomes lifetime tax optimization, and that changes everything. But Level 2 still has limitations. Most retirees at this level focus mainly on federal tax brackets. They still ignore several hidden tax traps that can dramatically increase retirement costs. That's where Level 3 begins. Level 3 is Medicare and Social Security coordination. This is where Roth conversion planning becomes much more sophisticated. Many retirees are shocked when they discover that retirement taxes are not just about income taxes. Your income can affect multiple areas simultaneously. For example, higher income can increase the taxation of Social Security benefits. It can also trigger Medicare IRMAA surcharges, which increase Medicare Part B and Part D premiums. These surcharges can cost retirees thousands of dollars annually. And here's what surprises many people. Roth conversions count toward the income calculations used for those surcharges. That means poorly timed conversions can accidentally create hidden costs. At Level 3, retirees begin coordinating Roth conversions carefully around these thresholds. They stop asking only, "How much tax will I pay this year?" Instead, they ask, "How does this conversion affect my entire retirement system?" That's a completely different mindset. For example, imagine a retiree converts too much in 1 year. The extra income pushes them above an IRMAA threshold. Suddenly, their Medicare premiums increase significantly 2 years later. Many retirees never see it coming. Sophisticated planning avoids this. Sometimes it actually makes sense to convert slightly less money to stay below a surcharge threshold. Other times it may make sense to intentionally cross a threshold if the long-term tax savings are large enough. The key point is awareness. Level 3 retirees understand the interaction between taxes, Social Security, and Medicare. They realize retirement planning is interconnected. And there's another major issue many retirees overlook completely: the surviving spouse problem. This is one of the biggest hidden retirement tax traps in America. Here's what happens. When one spouse dies, household income often decreases somewhat. But the surviving spouse now files taxes as a single filer instead of married filing jointly. That means tax brackets shrink dramatically. A widow or widower may suddenly face much higher tax rates on the same retirement income. Required minimum distributions can become more painful. Social Security taxation may worsen. IRMA surcharges may become easier to trigger. This is why many advisors aggressively consider Roth conversions earlier in retirement for married couples, because converting money at married filing jointly tax rates may be far cheaper than leaving surviving spouses trapped later under single filer brackets. Level 3 retirees start planning across both spouses' lifetimes, not just the current year. That's advanced thinking. But now we move into the levels most retirees never reach. Level 4 is multi-decade tax mapping. This is where retirement planning starts resembling professional tax engineering. At this level, retirees stop thinking year to year. They begin projecting decades ahead. They estimate future required minimum distributions. They model future Social Security income. They estimate survivor income scenarios. They analyze possible future tax law changes. They examine inheritance impacts for children. And then they create a long-term Roth conversion roadmap. This is dramatically different from reactive planning. Most retirees wait until tax problems appear. Level 4 retirees try preventing those problems years in advance. For example, imagine someone retiring at age 60 with a very large traditional IRA. If they do nothing, their future RMDs at older ages could become enormous. Those RMDs may force them into much higher tax brackets later. Instead of waiting, Level 4 retirees may slowly convert portions of their IRA every year for 10 to 15 years. The result? Lower future RMDs, lower lifetime taxes, reduced taxation of Social Security, lower risk of Medicare surcharges later, greater tax-free flexibility, and potentially better inheritance outcomes for heirs. This is where Roth conversions stop being isolated transactions and become part of a coordinated retirement income system. At Level 4, retirees also understand asset location strategy. Not all retirement dollars are equal. Traditional IRA dollars are taxable. Roth IRA dollars may be tax-free. Brokerage accounts may receive favorable capital gains treatment. Each account type creates different tax consequences. Sophisticated retirees learn how to strategically pull income from different accounts to manage taxes over decades. For example, one year they may use brokerage assets for spending while converting IRA funds strategically into Roth accounts. Another year they may delay conversions to avoid crossing important thresholds. Another year they may accelerate conversions if markets decline. And that last point is critical. Market declines can create massive Roth conversion opportunities. Why? Because you're converting investments at temporarily depressed values. Imagine converting $100,000 during a market downturn instead of after recovery. If the account later rebounds significantly inside the Roth IRA, all future growth may become tax-free. Sophisticated retirees often view bear markets differently from average investors. Instead of only seeing fear, they see tax opportunities. That's Level 4 thinking. And now we reach Level 5. This is the level most retirees never reach. Level 5 is what many advisors quietly focus on behind the scenes. It's not just about reducing taxes. It's about controlling retirement flexibility, legacy planning, tax diversification, and future uncertainty all at once. Level 5 retirees understand one critical truth. The future tax environment is unknown. Nobody knows exactly what tax rates will look like 10, 20, or 30 years from now. Nobody knows future Medicare rules. Nobody knows future Social Security adjustments. Nobody knows future inheritance tax laws. So instead of trying to predict the future perfectly, Level 5 retirees build flexibility. And Roth assets create flexibility, unlike almost anything else in retirement planning. Why? Because Roth IRAs can give retirees powerful control over taxable income later. Imagine two retirees with identical net worths. One has nearly all retirement savings in traditional IRAs. The other has a balanced mix of traditional accounts, Roth accounts, and brokerage assets. Which retiree has more flexibility? Usually the second one, because they can choose where income comes from. If they need extra spending one year, they may use Roth withdrawals without increasing taxable income. If tax rates rise, Roth assets become even more valuable. If Medicare thresholds become tighter, Roth withdrawals may help avoid surcharges. If markets crash, they can strategically rebalance from different account types. If a surviving spouse faces higher tax brackets, Roth assets may soften the impact. If heirs inherit accounts, Roth treatment may be far more favorable than fully taxable inherited IRAs. Level 5 retirees understand diversification is not only about investments, it's also about tax diversification. That concept is incredibly important. Most people diversify stocks and bonds, but sophisticated retirees diversify future tax exposure. They build pools of money taxed differently so they can adapt later. And here's another Level 5 insight many retirees miss. Roth conversions are not always about maximizing returns. Sometimes they're about reducing future risk. That's a huge mental shift. Many retirees obsess over getting the absolute lowest taxes possible this year, but Level 5 retirees think differently. They value predictability. They value control. They value flexibility. Sometimes paying a reasonable tax rate now is worth avoiding massive uncertainty later, especially when retirement can last 25 or 30 years. At Level 5, retirees also understand sequencing risk in taxation. Future tax spikes can be dangerous. For example, large RMDs, selling appreciated assets suddenly, widowhood, major capital gains events, healthcare costs, tax law changes. All of these can create unexpected tax pressure later in life. Roth assets can help absorb those shocks. This is why many advanced retirement plans intentionally create tax-free reservoirs through gradual Roth conversions over time. And one more thing separates Level 5 retirees from everyone else. They stop viewing Roth conversions as a one-time tactic. Instead, they build ongoing annual decision systems. Every year they reassess current tax brackets, market conditions, future RMD projections, legislative changes, Medicare thresholds, cash flow needs, inheritance goals, Social Security timing, portfolio balances. And based on those factors, they decide whether conversions make sense that year. Sometimes the answer is yes, sometimes no. The point is intentionality. Average retirees react. Level 5 retirees optimize. Now, an important warning. None of this means everyone should rush into massive Roth conversions immediately. That would be a mistake. Poorly planned conversions can absolutely backfire. Converting too much in one year may create huge taxes unnecessarily. It may trigger Medicare surcharges. It may increase taxation of Social Security. It may create state tax problems. It may reduce certain tax credits or deductions. And if retirees use retirement funds themselves to pay conversion taxes, the strategy may become less effective. This is why careful planning matters so much. Roth conversions are powerful precisely because they affect multiple parts of the retirement system simultaneously. And that's also why many retirees underestimate them. Because at first glance, the strategy sounds simple. Pay taxes now to avoid taxes later. But at higher levels, Roth conversion planning becomes deeply connected to retirement income design, tax management, healthcare costs, estate planning, and long-term flexibility. That's why advisors spend so much time modeling these decisions carefully. And here's another critical point. The earlier retirees start learning about Roth conversions, the more opportunities they may have. Waiting too long can limit flexibility. Once massive RMDs begin, the tax problem may already be much harder to control. That doesn't mean older retirees can't benefit. Many still can. But the planning window matters. Even retirees in their early 60s may have enormous opportunities if they plan strategically before Social Security and RMDs fully begin. And younger investors should pay attention too, because tax diversification built gradually over decades can become incredibly valuable later. Many people spend their entire careers focusing only on pre-tax savings because they want immediate deductions, but retirement eventually reveals the other side of the equation. Deferred taxes are still taxes, and future tax conditions may not look like today. That's why some retirees intentionally build both traditional and Roth accounts during working years. Again, flexibility matters, and flexibility becomes more valuable when uncertainty increases. Now, one of the biggest misconceptions about Roth conversions is the belief that they are only for wealthy retirees. That's not true. In fact, moderate income retirees may sometimes benefit the most from strategic conversions because they often have temporary low-tax windows available, especially between retirement and required minimum distribution age. That period can create opportunities to convert money at surprisingly low tax rates. And another misconception is that retirees must convert everything. Also not true. Many sophisticated strategies involve partial conversions over many years. The goal is usually optimization, not perfection. Some retirees may intentionally keep enough traditional IRA income to fully use lower tax brackets later. Others may prioritize reducing future RMDs. Others may focus on inheritance planning. Others may focus on Medicare management. There is no universal answer. That's why Roth conversion planning becomes highly individualized at advanced levels. And that's also why blanket advice online can sometimes be dangerous. A strategy that works brilliantly for one retiree could be terrible for another. Because retirement tax planning depends on multiple moving variables: income sources, age, marital status, state taxes, future pensions, Social Security timing, portfolio size, health, inheritance goals, charitable giving, spending needs, and expected longevity. All of those factors matter. But despite the complexity, the underlying lesson is simple. Most retirees underestimate taxes in retirement. They spend years focused on investment returns while ignoring future tax exposure. Yet taxes may become one of the largest expenses retirees face over time. And Roth conversions are one of the few tools that allow retirees to proactively reshape that future. That's why understanding these 5 levels matters. Level 1 is basic awareness. Level 2 is tax bracket strategy. Level 3 is Medicare and Social Security coordination. Level 4 is long-term tax mapping. Level 5 is full retirement flexibility and tax diversification planning. Each level builds on the previous one, and the higher the level, the more retirement planning shifts from reactive behavior toward intentional control. That's what sophisticated retirees and advisors understand. Retirement is not only about growing wealth, it's about managing how wealth flows through the tax system over decades. And often, small strategic decisions made early can create enormous differences later. A well-timed Roth conversion today may reduce future RMDs for decades. It may reduce future Medicare costs. It may reduce survivor tax pressure. It may create tax-free income flexibility later. It may improve inheritance efficiency, and it may help retirees feel more confident about future uncertainty. That last part matters more than many people realize. Financial peace in retirement often comes from flexibility and predictability. Retirees who understand their tax exposure tend to make calmer, more confident financial decisions. They are less likely to panic during market volatility, less likely to fear future tax changes, less likely to feel trapped by mandatory withdrawals, because they've built options. And options are powerful. So if there's one major takeaway from all 5 levels, it's this. The true power of Roth conversions is not just tax-free growth, it's control. It's control over future taxable income, control over retirement flexibility, control over healthcare-related costs, control over legacy planning, and control over uncertainty itself. Most retirees never reach that understanding, but the ones who do often approach retirement very differently from everyone else. They stop asking only, "How much did I save?" and start asking, "How efficiently can I use what I saved?" That's the question sophisticated retirement planning is really about.